Hello. In this video, we're going to be going over the perpetual versus the periodic inventory system. Let's look at an overview of some terminology that you should be familiar with, but we'll just refresh your memory just in case. Inventory refers to the assets of a company that they intend to sell in the normal course of business. So if I am a clothing store, the clothes are my inventory. This is my business and I intend to sell it. Cost of goods sold is an expense, which means it goes on the income statement and it represents the cost of the inventory sold during the year. So we record cost of goods sold when inventory is sold. Um, and if you don't know, the formula for cost of goods sold is we take our beginning inventory plus our purchases, less any discounts. Um, and that gives us what's called um, cost of goods available for sale. And then we subtract the ending inventory, and then we get to our cost of goods sold, which goes on our income statement. There are two types of inventory: merchandising inventory and manufacturing inventory. Let's start with manufacturing. Manufacturing inventory are the inputs for inventory that get manufactured, and they have they consist of raw material, work in process, and finished goods. So this is inventory that are actually made. They manufacture items versus merchandising inventory are just goods that are purchased and in finished form from a wholesaler or retailer. So think about the clothing store. If I am a clothing store and I just buy all my clothing from my supplier, from my vendor, I'm a merchandising inventory. The company that makes all the clothes, they are the manufacturing inventory. They have manufacturing inventory. And the cost of the merchandise of the inventory of the merchandising inventory is not just the purchase price of the inventory itself, but there are other costs that are incurred that we include in the purchase, that we include as part of inventory that to get the goods in condition for location and to get the goods in condition and location for sale. Let's start with the perpetual inventory system. A perpetual inventory system, right? So that's going to be the first type of inventory system we talk about, and the most common is one where the inventory count is constantly being adjusted and accounted for any purchase, sale, or return of inventory. So therefore, at the same time, for any inventory item that's sold or returned, the cost of goods account is also continuously adjusted. And this allows management to know how much inventory they have at any point on hand. In order to maintain a perpetual inventory system, you need technology. And so nearly all the major companies use a perpetual inventory system to record their inventory transactions. And think about, like, if you go into a clothing store and you see a shirt and there's no medium out on the floor, and you ask one of the sales clerks to say, hey, do you have a medium of this shirt in color blue? And they look at their little handheld device that they all seem to be carrying these days, and they just look and they're like, yep, we have 4 of those in the back, let me go get you one. Well, that's because that clothing store uses a perpetual inventory system. And so every time an item is sold, they scan a barcode and it reduces their inventory, and vice versa. When they purchase, they update their inventory system automatically. So it always gives you a good idea of where your inventory is at. Let's go through an example of the perpetual inventory system and how we record the entries when items are purchased and sold. So in this example, the Lothridge Wholesale Beverage Company purchases soft drinks from producers and then sells them to retailers. So they don't manufacture it, so they are a merchandiser and they sell merchandise inventory. The company uses a perpetual inventory system, and the beginning of the year inventory is $120,000. We're going to go number 1 and 2 in this, actually all 3. Additional soft drink inventory is purchased on account at a cost of $600,000. So this is just your typical purchase of inventory. So for number 1, we debit inventory and we credit accounts payable for the $600,000. And the reason we credit accounts payable is because it says on account. Then the sales for the year on account totaled $820,000. So we record number 2, we record our sales revenue for $820,000. We did not receive cash, it's on account. So we debit accounts receivable. And then number 3, the cost of the soft drink inventory sold is $540,000. Whenever you sell inventory, it is a 2-step entry. It is 2-step. The first step is this one right here where you record the actual sales. And the second step is when you have to remove that item that was sold from your inventory and put it into your cost of goods sold. This is how you're going to expense it at the cost of that inventory, which they tell us is $540,000. So we debit cost of goods sold and credit inventory. So that's how you record a perpetual inventory system. Every time inventory is purchased, this is made, and every time inventory is sold, these 2 entries are made. The second type of system is the periodic system, and this is a less commonly used. And that's because in the periodic inventory system, the inventory account and the cost of goods sold is only adjusted at the end of each reporting period. And so in the periodic inventory system, any merchandise purchases or returns or any discounts in freight in, which is the transportation costs, are booked in, or recorded into temporary accounts, which are then zeroed out into the cost of goods sold account and actual inventory accounts. But the way we calculate the cost of goods sold is the same. You take your beginning inventory plus your net purchases, and net means that it includes the discounts, the returns, and the freight, and minus your ending inventory gives you your cost of goods sold. So let's go through an example. And it's the same example. Well, yeah, it's the same example or very similar. The Lothridge Wholesale Beverage Company, right, purchases soft drinks and sells them to retailers, and they use a periodic inventory system. The beginning of the year inventory is $120,000. So number 1 says additional soft drink inventory is purchased on account at a cost of $600,000. So you'll see number 1, what they debit is purchases for $600,000 and they credit accounts payable because it's on account. In the perpetual, we debited inventory, but periodic, we have this temporary account called purchases. Number 2, the sales for the year, all on account, totaled $820,000. This entry is no different than the perpetual. We debit accounts receivable and credit sales revenue for $820,000. Now, if you remember, in the perpetual inventory system, whenever we make a sale, it's a 2-entry system. One was for the sale, and the second entry was to record the cost of goods sold. If we go back up here to the perpetual, here it is, the number 3, right? When we have a perpetual, a sale of inventory under the perpetual, we always record the sales and we always record the cost of goods sold in inventory right here. But with the periodic, we do not, because we do not update our inventory and cost of goods sold at the time of sale. Those things are done at the end of the period, which in this situation, in this example, it's at the end of the year, and we are told that the cost of the ending inventory is $180,000. So now we have to calculate what is the cost of goods sold under this periodic inventory system. So let's just look at the formula, right? It tells us that our beginning inventory is $120,000. Here's our formula right here that we use to calculate cost of goods sold. So it tells us our beginning inventory right here, $120,000. Our net purchases, what did we acquire during the year? It says during the year we purchased $600,000. So here's our plus $600,000. And we come to this line item, and that subtotal is called the cost of goods available for sale. That's the $720,000. And then we subtract our ending inventory, which we're told is $180,000. So that means our cost of goods sold is $540,000. So let's see how we record that entry. So going back into our example, we're going to start just right here at the bottom of this screen. We're going to debit cost of goods sold for $540,000, and we're going to remove our beginning inventory and purchases that we made. So we're going to credit inventory and credit purchases, and we're going to increase our inventory by the $180,000. By doing this entry right here, by crediting the beginning inventory and purchases, we're taking off whatever is on our books for inventory, we're removing, and then we're just going to put on the ending inventory of $180,000. So at the end of the day, our ending inventory will be the correct balance. So just a quick recap for the difference between the perpetual and periodic. The perpetual, which is more commonly used, updates the inventory and cost of goods sold at all times. Like every time a transaction occurs, it's updated, which therefore gives us more timely information for management and reporting. Although this does involve some higher record keeping costs, the technology that we have today actually helps minimize this cost. The periodic is going to be the inventory and cost of goods sold is only updated at the end of each period. So you never really know how much inventory you have on hand. And the way you find out is you need a physical count of the inventory at the end of each period. And the record keeping is limited because you don't have to do much during the period. But again, there's disadvantages of that. The impact to the financial statement of choosing one system over the other is generally not significant, and you wouldn't expect it to. The type of inventory system you use to keep track of your inventory, you would expect that at the end of the day, at the end of each period, it should give you similar or exact information.